This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in Chapter 10, we now get eventually to the end of our studies of the income tax computation, at least in terms of those matters that impact directly on the preparation of the income tax computation. We've seen throughout these chapters, mostly concentrated on the sources of income, and how it is we establish the amount of such income, whether it's employment, self-employment, or any form of investment income, how we determine the amount of such income to include within the income tax computation. And we've also looked at various payments that have been made by the taxpayer that may in some way achieve some degree of tax relief. And here in Chapter 10, we look at the pension scheme contributions. Now, I trust that you have, since last time, looked at the particular parts of the previous chapters, Chapter 2 and Chapter 9, that would help you in terms of the content of this particular chapter. Wherein, in Chapter 9, we looked at occupational pension scheme contributions and discovered how, where, as would be a requirement of any such scheme, an employer makes a contribution into an occupational pension scheme, that is an exempt benefit. And that then any further additional contributions made by the employee, well, they're allowable deductions against the employment income assessment. Compare that with the situation on personal pension contributions. Personal pension contributions that don't feature as a deduction on the face of the income tax computation when paid by the individual. This time individuals who again might be employees, but this time maybe employees that work for maybe a smaller employer that doesn't run an occupational pension scheme. Although more often we see the personal pension contributions in the context of the self-employed. There is nobody else to look after them other than the state, that is, in terms of a pension, when they achieve pensionable age, and on that basis, therefore, they can look after themselves. And that's where personal pension contributions come into play. So hopefully you've revised through that. Now then, the lectures that you're about to see, a couple of lectures, so it's a relatively brief chapter here. The lectures that you're going to see on these chapters are, again, old lectures taken from last year in relation to the impact that they have in terms of the income tax computation. And all I need to do in this brief introduction to those self-same lectures is to point out a couple of things that have changed, which actually you already know about from previous work that we have done. And they impact on, in terms of computing the taxable income, we have, of course, a personal allowance to deduct from net income to derive that taxable income. But we know that when adjusted net income, when that adjusted net income exceeds the £100,000 income limit, that we get a reduction in that personal allowance. A personal allowance that for the 21-22 tax year, a personal allowance that is £12,570, but back in the previous 2 years, it was only £12,500. So not a huge difference, but it's now £12,570. That meant that when adjusted net income exceeded £125,140, that would involve or result in the total removal of the personal allowance. The restriction would have come down and down and down. So by the time that adjusted net income, again another issue in terms of where personal pension contributions come into play, adjusted net income, when it exceeds 125,140 for the 21-22 tax year, then that was going to result in a zero personal allowance. Now, given that the personal allowance in the previous couple of tax years was 12,500, that income limit was 125,000. So in the lectures that you're about to see, you're going to see issues whereby the adjusted net income limit exceeding 125,140 in the lectures exceeds 125,000 and therefore reduces the then personal allowance of 12,500 down to zero. These numbers, in terms of your examples, are much bigger than that cut-off limit. So it's the same answer. There will be no personal allowance available. What we've also had a change in the tax calculation is the basic rate band limit. a basic rate band limit where you went from 20% basic to 40% higher rate tax, at least in terms of savings and non-savings income anyway, that particular limit for our tax year, as you know from your rates and allowances pages and all the practice that you've had there on up until now, that limit is £37,700. Well, back in the previous couple of tax years, it was £37,500 there. Now that will show up in relation to, when you look at the notes now, which we have here, you will see towards the end of section 1 on these pension contributions, we talk about personal pension contributions and an extension of the basic rate band. And in this particular example here, we had a gross personal pension contribution of £10,000. So extending a basic rate band of 37,700 by 10,000 puts it up to, as we can see there, 47,700. Well, in the lecture, that figure is going to be 47,500 because the then basic rate band limit, as I've just said, was £37,500. But again, watch the lectures, but use these notes. We are using the 21-22 figures. Moving through in terms of the notes, on to will be in the second of the two lectures, the annual allowance charge, where we see with personal pension contributions, again, an extension of the basic rate band. In this particular example, there is a huge amount of gross personal pension contribution, such that with a gross contribution of £70,000, then 70 on to 37,700 gives you 107,700. Well, last year, and in terms of the lectures you're about to see, that figure will read 107,500, being an extension from 37,500. Use these numbers, however, here in your 21-22 notes. There you see in the tax calculation, therefore, 107,700 being used, and that will differ to what you see when we look at the answer to this in the lecture, whereas last year's figures at 107,500. And that first point that I made about the adjusted net income and the point at which the personal allowance will reach zero on the restriction above the adjusted net income limit of 100,000, that for us now is 125,140, given that we have a £12,570 personal allowance. Well, as I said in the previous 2 years, and what you'll see again in the lecture, is that that figure there will be £125,000. So it's only those few numbers that have changed. There's absolutely no change in the principles and the rules that are applied. So from this point onwards, you're going to see the first of the two lectures recorded in relation to our pension contributions. Again, I trust that before you do this, you've looked back to see the issues that we saw in Chapter 2 on personal pension contributions, what I've just said about the adjusted net income calculation as regards restriction of personal allowance, and also about the extension of the both basic rate band, which is going to be relevant here, and also higher rate band limits that you'll also see relevant. The only difference is that the higher rate band limit hasn't changed from the last few years to this year. It's only the basic rate band limit that's gone up that tiny little amount from 37,500 to 37,700. Okay, over to me now last year, therefore, to work through the situation and the issues that we need to know about when dealing with pension contributions.